We turn our attention now to developments in the property sector, as there's good news on that side of the residential rental market. A residential rental market monitor by TPN Credit Bureau has revealed a resilience in this space despite a rally in interest rates. According to that report, the number of tenants in paying their monthly rental obligations well in time and in full has increased. TPN's Waldo speaks to us about this. Thank you so much for your time, Waldo, once again. It's quite interesting that we see this resilience within the rental property market, given that interest rates are going high. What are the attributing factors?
Good morning, Jimmy, and thank you for having me. Yes, the residential rental market has shown quite good resilience. Also understanding that 82% of tenants is in good standing. Those are people who have paid the rental up and in full at the end of each month. And that is almost a 2% climb from the first quarter of this year. And although we haven't really seen a massive change in the number of properties being transferred when it comes to sales, we have seen the recent statistics from South African Reserve Bank that the number and the value of mortgages being granted in quarter two is starting to dip. Now, those are early indicators to us that there's a bit of a slowdown in property appetite to purchase. And traditionally, then those people looking to purchase would migrate over into rental properties to better understand what the interest rates are going to do, wait it out a little bit, have a better understanding of the general economic environment in which they will be functioning.
So essentially a two-sided coin like any other situation, but given the precarious economic climate, is it safe to say that the latter is likely to gain momentum as we are seeing this resilience within the rental property space, like you explained, that there is that dip that we are seeing in the number of sales, but at the same time there's this transfer to another side of the market?
But there's three indicators we need to look at. One is the vacancy rate. That has also come down, meaning there's a bigger appetite. The second one is that escalations are slowly creeping up, but that's predominantly driven by by inflation. Landlords at some point will have to pass on these additional costs in various forms to tenants. That again will then impact the demand a little bit as rentals creep up. People have less money to spend. And we all know that the third big factor is the consumers are really under huge pressure. Food prices, fuel prices, and at the end of the day is you have to make do with what type of income you're receiving. Now that might mean that people stay within the in the rental market. They might move up or down. We still see the sweet spot for rentals between 7 and 25,000 rand. They've got the best rental collections. But one big notice is that consumers almost always will pass on some of the strain that they're feeling towards landlords, either by means of late payment or negotiating a low escalation, or consolidating, people moving in together, starting to share rentals, then staying on their own.
That's quite interesting. How much of that is being seen? Our last conversation just over a month ago was essentially around those trends that we are seeing in the property market. How much of the dynamic has changed when it comes to consolidating or even just making do with what the rental purpose basically gives you as an option, particularly when it comes to negotiating late payments with your landlord?
Well, I think to answer your first part of the question is that trend continues. Usually the rental brackets between 7 and 12,000, usually 2 bedrooms, 2 bathrooms, young professionals sharing, or families renting bigger premises so that they can, students that come and stay with them rent out additional space. We've seen that trend continue, and we've actually introducing new types of lease agreements to accommodate that specifically for that type of demand. Negotiating rentals, I think at this stage is going to be a really tough one. Landlords have absorbed quite a lot of the inflationary costs since COVID. They haven't increased rentals dramatically because it is expensive, and they'd rather sit with a property that is occupied than vacant. We can see that dynamic work very well in Gauteng at the moment. We've seen rental escalations remain below the 2%, but we've seen vacancies fall, and that is working on a good market dynamic. Places like KwaZulu-Natal as well as the Western Cape still enjoying higher escalations, but their vacancies are kind of stable, have not decreased in the past couple of quarters.
Lastly, Waldo, what picture does it paint, if much at all, of the property space in South Africa currently? I asked this question because last week we had a discussion around the higher levels of the market where the resilience is also shown there, but we do know that it's a very small percentage of the South African citizenry that plays its role there.
See, the high-end market, the individuals, both in the residential space and those that wants to invest in purchasing, have a bigger buffer, especially when inflation starts taking up. The lower end of the market, below 3,000, is still not recovering, and it's going to take a while for them to get out of it, especially with inflation sitting at the 7.8%, potentially touching on the 8%. So your higher-end market, although they are a bit more resilient, these type of inflation figures will hit them, highest interest rates, and at the rate of which those interest rates are going up and expected to go up, we're going to start seeing a bit of a slowdown in the higher end market as well.
Thank you as always for your time. Waldo is from TPN Credit Bureau talking to us this morning on the business desk about resilience that's been seen in the rental property space.